Welcome, everyone. My name is Mary Shear, and I am super excited to be with you tonight, especially because I have my friend and colleague, Sandy Furuya, on Zoom with me. And I've known Sandy and I've known each other. She's been my number one math girl and tax accountant and all of those things, friend rolled up in one. But I want to do a real formal introduction because I want you to get a sense of who she is and her expertise. I want to tell you first a little bit about where she's from. Since 1975, her company, Wamhoff Accounting, has been serving small businesses, business owners, nonprofits, family trusts, and individuals for all of their accounting needs. After over 35 years with Wamhoff, Sandy was named president of the firm's accounting division in 2017. Congratulations, Sandy. Very deserving. Leading a team of 10 tax and accounting professionals and setting strategic direction for operational, promotional, and client service activities. Over the course of her career, Sandy has built a reputation for her work with small and medium-sized businesses, delving first into what matters most to each business owner, exploring overall financial goals, and developing a plan to address taxes, budgeting, financial statements, and more. She and her team serve as tax and accounting consultants for clients all year, not just at tax time, reviewing financials, making recommendations to keep the client's tax management plans on track. In many cases, the team is involved in consulting from day one of a new business. So all of you that are listening that have a Juice Plus business, you have an international virtual franchise business. You can do a little or you can do a lot. And so I think it's necessary, honestly, once you start making a nice part-time income, even before, to have a plan. And so that's where Sandy came into play for Steve and I. In many cases, the team, like I said, they are involved in consulting from day one of a new business, providing services to get the business started properly, helping to set up the accounting systems such as QuickBooks, and providing outsourced accounting services such as bill paying, government reporting, tax projections, and preparation of tax returns for the business and the owners. Because Wamhoff also is a full-service financial firm, they offer both financial planning and accounting, and the teams work seamlessly together to offer services such as the establishment and management of 401k plans, IRAs, retirement plans, and other investments. What I like about Sandy is she is real. She is down to earth. What I respect about her is she is the ultimate businesswoman, honestly. She tells you the truth, and I love that. And what I love about Sandy is she's got my heart because she is a wife and a mama. She loves her kids and a Mimi. So I hope she tells us about them. Actually, I'm going to ask her to tell us about them. So thank y'all for being here. You're going to love this. Get your pen out and your paper so you can take notes. Sandy, would you just tell us a little bit about you? What made you be an accountant and how all that good stuff, your family?
Well, first of all, thank you for that introduction. That was very nice. So I actually took a bookkeeping class in my sophomore year of high school with Mrs. Glover. Loved her. She was a great teacher, and just found that I really enjoyed that side of the business, that part, the bookkeeping part, the debits and the credits and that, and I was good at it. My family does come from an accounting background. We were either accountants or electricians, and obviously I can't change a light bulb, let alone any electrical, so I chose the accounting field. So with my brother and with my mom as well, Bob started the accounting practice.
That's so awesome. I didn't know your mom was part of that. That's really cool. A family,
it was.
For sure. So tell us a little bit about your family now, your husband, your kids.
So in September, I will be married to my wonderful husband, Don. He's the love of my life. We have 2 kids. They're both grown. My daughter is 26. She recently got married and has a stepson, my step-grandson. And I'm also very proud of my granddaughter, Janelle, a little girl who's 3 and a half. Both of them steal my heart. And I'm going to, have an older son, or a younger son, a younger son that is 23, And he's actually down in Houston doing very well for himself. He's actually self-employed as well. And he's a personal trainer coach, like for your meals, things like that. So he's like a life coach. So very similar, wants to be well. So helps his mama out from time to time. So, and then we have our dog, Sam. He's a black lab mix who we love now that we're by ourselves. Don and I, we hang out with him quite a bit.
That's so awesome. Well, I want to thank you so much for doing this for us tonight, Sandy. And a lot of people that are listening eat Juice Plus. They might be representatives, or they might just be eating Juice Plus. So you have a little bit of a Juice Plus story. So would you share with us what made you get started?
Sure. Probably about 12 years ago, and I kind of forget the date. I want to forget the date. I got really sick. I was, to the point where I was achy all over constantly, could not get out of bed, could barely walk, lost a ton of weight, and kept going to the doctor, and they were trying to figure it out. So probably a year and a half later, I was diagnosed with lupus. And it affects my joints. I also have to be careful and watch for my kidneys and my liver and other organs in that. So I had pretty much hit rock bottom. And I had met you, and you talked to me about Juice Plus, and I thought, why not give it a try? Been on it ever since. Loved. I feel really great. I have had a positive ANA count for probably 4 or 5 years.
Oh.
I'm able to get through tax season, which is very busy for me, and get through daily life. It's not to say that I don't have the pain anymore, but it's manageable. And that is a godsend for me.
Awesome. Well, I wish I could hug your neck right now. I get so excited to hear stories like that because I want to help people. And I can't tell you how much Sandy has helped Steve and I. So I'm going to let her take over this portion of the talk tonight. And actually, if it's okay with Sandy and we're on time, if I see questions in the comments, maybe we'll take some questions. We'll see. You all won't be able to talk to Sandy, but I'll look on Facebook as she's doing this, and I'll look here in the comments and see if there's any questions. And then last year, she provided us an outline of sorts afterwards. So I'll be sure and take her to lunch so she gives us that too. So, but I just love this. So Sandy, I'm going to take away my audio and video, and it's all on you.
Right. Well, thank you again for having me this evening. It is an honor to be able to talk to people that are in business, and that's what I love to do. So I wonder how satisfied you were with last year's tax return and with the new tax reform. It's so complex that you probably were looking at it and hoping that you had a tax advisor that helped you, and I hope that is the case. According to stats, it's about 50-50. 50% of the individuals love the new tax reform. 50% said, no, not so sure. Obviously, the refunds were lower. And that's because, in essence, you got the money in your paycheck every time throughout the year. So, but you got to realize that refund, no matter what it is actually your money. So that's due back to you. And it's important to choose the right tax advisor, your right investment advisor, your right banker. Just as you choose, what grocery store to go to or where you get your car fixed, it's also important to find a good tax advisor. Tonight we're going to discuss business and how to maximize your deductions, as well as plan for your future. I know you all want to grow your business out there, and that's what it's really about. So before I dive into the business part, I do want to go over a couple items for the individual return, which obviously if you're in business, you're going to have to file your business tax return, and many of you are on what's called a Schedule C with your personal return. So the good news is the tax rates did go down. They're the lowest they've been in a long time, and that was great news for people. However, some things that were taken away from us. Many of us did not itemize anymore because the standard deduction is now so high, 24.4 for married filing joint, and you get a kick up if you're 65 or older. So one of the keys that we do as a tax advisor, we take a look on how close they are on the itemized deductions, and then possibly maybe bunch your charity. If you give to a certain charities that you believe in, such as your church or other charitable organizations, bunching those in 1 year so you're able to take the itemized deductions. And then the following year, you do take the standard deduction. And those are tools we use and we advise our clients on. The medical expense. Unfortunately, medical expense, now you have to do 10% of adjusted gross income. But what's great about that is if you're a self-employed individual such as yourselves and you pay for your health insurance out of pocket, you actually get a deduction on page 1. That is huge for individuals that are actually in business. Another tool we use quite a bit is the HSA deduction. That's a health savings account. Those are nice tools for savings, not just to pay for medical expenses, but maybe for medical expense in the future. So as a business owner, whether it be Juice Plus or some other type of business, you have several advantages. You're able to deduct any necessary and ordinary business expenses that you need for your business. That pretty much keeps it wide open as long as you document and keep track of your receipts and it's not anything unusual. I actually have customized a chart of accounts for Juice Plus because you are unique. You have different strategies like your client development, things like that. So I actually have a chart. So if you'd like a copy, I'd be glad to give it to Mary and she can pass it along. You also get a home office deduction. If you have exclusive use of your home, you can take that portion of your home and be able to deduct certain expenses. Now remember, I told you you couldn't many people didn't itemize the use of standard deduction. Well, that's where you can actually take some of that mortgage interest, your real estate taxes, and move it over to your Schedule C. You just have to have exclusive use. And then you're going to also be able to take your mortgage insurance, your improvements, your utilities, those type of things, which are typically not deductible anywhere on that return. The largest portion that we found that everybody was pretty excited about, even though they did not know how to calculate it, is the qualified business income deduction. If you're a flow-through, whether it be a sole proprietor, a partnership, an S-corp, you are actually able to take 20% of either your taxable income or your profit on your business after expenses and deduct it right on your return. There are limits to that. They're thresholding, they're actually raising them each year, but it's a great opportunity. And there's also some planning tools to do that for deciding, where to maximize that deduction. And we're able to help clients actually maximize that deduction. But that's the great one that's happening over the next few years, the QBI deduction. Now, in order to do that, you have to be a qualified trade or business. And all the Juice Plus reps are definitely a qualified trade or business. So you will have the opportunity to use that. If you're in another business, such as a professional service business, such as a doctor, or maybe a financial advisor, you do have some lower limits, but there's still a great opportunity there to be able to take that deduction. Another terrific deduction is your vehicle. And I was just reading on my LinkedIn tonight, the IRS had posted about vehicle expenses. Should I deduct those or not? Right now, the mileage rate is 58 cents. And I know many of you do travel quite a bit. And even when you go to your conferences, you typically might drive versus flying. So your 58 cents a mile is for all business miles. And what's really unique about a home-based business is you start your business miles the minute you walk out that door. Whereas other people, if they have a place they go to business, such as myself, I have an office. My first going from my house to my business is commuting and not deductible. But a home-based business, you're pretty much, if you're going out for business, you're going to have some high business mileage to be able to take advantage of. So you probably don't know, when should I use the exact mileage rate, or when should I use exact expenses. And that's determined usually the year you place it in service vehicle. If you're driving a lot of miles, probably the mileage rate's going to be better. But in many cases, you might actually use actual expenses because of the new bonus depreciation rules. Bonus depreciation is a great way to even buy a used vehicle and get to write it off at a more rapid pace. You're actually going to get $8,000 plus another $10,100, so a total of 18,100 times business percentage on that depreciation of that vehicle. Say it's a Toyota Camry. And then you get to take all your actual expenses too. So your gas, your insurance, your oil changes, when it needs tires, when you renew the plates, things like that, even your car washes. So instead of having your kids wash your car and do a good enough job, you can actually take it to the car washer by one of those passes. Again, it's going to be your business percentage. Nobody really has 100% business percentage on a vehicle unless it's specifically suited for their industry, such as a plumber, a plumber contractor or an electrician. They might have those specialized vans. So that's a regular vehicle, a luxury automobile according to the IRS, which, by the way, is about $23,000 for the IRS to say it's a luxury vehicle. There's nice write-offs for SUVs. If you need a vehicle such as an Expedition or maybe a Dodge Durango, those are over 6,000 pounds. Being over 6,000 pounds gives you the qualification to actually write off $25,000 worth of what's called 179 expense, plus the balance of the vehicle with bonus depreciation. So you can actually pretty much write off that entire vehicle, again, times business percentage, plus your actual expenses. What's really nice and what we work with a lot is if somebody is needing a new vehicle and they're needing it toward the end of the year and we discuss it, as long as they drive it off by December 31st, it's a full write-off. It's pretty unbelievable, but that's what happens. So it's great. A lot of people buy trucks. Trucks seem to be popular right now, and you can have everything you want on them, and those also have a better write-off as well. Many of you, obviously with the technology, need new laptops, maybe a new tablet, maybe a new desk for your office. Pretty much you can write off that pretty much instant gratification in the year you place it in service. Now, if you don't need it, you can definitely depreciate it over the life, but typically people that are doing a large volume are going to take the instant gratification and write it off immediately. So pretty nice. Some other tips for business owners: you do want to set up a separate bank account. That is a really good idea, especially to keep your trail of your personal expenses and your business expenses separate. We always recommend a separate business bank account for the business. You do want to keep things separate, so if you have 2 credit cards, maybe use one for your personal, one for your business. So also, another item is when you take someone out for a meal, make sure you document it. We call it the P's. It's purpose, place, and the what you're talking about. Like, for example, if Mary and I go to lunch and, we talk about Juice Plus or about the bookkeeping part of it, then we'll be able to write that off whoever pays for it. And you want to make sure too, your meals have substantially changed. Before we could write off meals, some of them were 100%, some of them were 50%. Your entertainment used to be written off. Now, unfortunately, the government did change some things with the tax reform, and they actually now, unless you're doing a holiday party for all your employees and your spouses, that'll be 100% deductible. Doing a marketing presentation definitely will be 100% deductible. Or a team building exercise, those are 100% deductible. What's not deductible, if you'd like to go to, a baseball game or hockey. Here in St. Louis, many people were going to the Blues hockey this year because we won the Stanley Cup. And those are not deductible, even if you're taking a client or a prospect. The meals for the inconvenience of the employer, required business meeting, including like the Chamber of Commerce or Rotary, those are going to be 50% deductible. So you'll be able to take them 100% on your book side, but then you adjust for it when you do your tax return. And you can still take your meals while you're traveling overnight. And then definitely with your clients and your prospects, all 50%. And again, we have a nice chart that we provide to our clients just so they can categorize them properly, so that at the end of the year, we're not going, okay, this meals and entertainment is all lumped. Can you tell me what this is all about? And we really try and educate our clients all year round through our website, through our social media posts, my blogs, and that. So definitely check that out if you get a chance. The last item I want to talk about is we do a lot of tax planning. And the reason why it's so important, especially for business owners such as yourself, is to make sure you've got your withholding covered or your through estimated tax payments. There might be a situation where your spouse works full-time and has plenty taken out, and it doesn't affect you because you have a smaller Juice Plus business. But as you grow, you're going to find that you're going to end up short 1 year, and then the IRS is going to penalize you. Last year, they were very gracious with the new tax reform, and as long as you had 85% of your tax liability for the year paid in, they were fine and did not penalize you. This year, the rules are as they always have been, with the exception of last year. You have to pay in 90% of this year's liability, or 100% of last year's liability, or 110% if your AGI is over 150,000 if you're married filing joint, and 75 if you are single or head of household. This is so important to check your withholdings out. There are apps on irs.gov that can help you. Get your tax advisor to sit down and make sure you're covered, because penalties are just money out of your pocket, not deductible. No. I hope you found this useful. I could go on and on about a lot of information, but I know that we're limited on time. And I definitely would be happy to answer, any questions people may have. There's probably burning questions out there.
Wow, Sandy, that was so awesome. I did see a couple questions. I'm going to keep looking on all my places I'm looking. But the one question that was asked, to get the QBI deduction, do you need to be an S Corp or incorporated?
Good question. For the QBI deduction, it's all flow-throughs. So it is Schedule C, sole proprietors, which many of you are, partnership, or an S Corp. The C Corps are not. They stand on their own. They're their own entity, and they actually pay their own tax. They pay a flat now 21%. So whether you do $1 worth of income or $1,000 worth of income, that is taxed at 21% for the federal rate, and then the states will vary. So yes, S Corp or Schedule C or a partnership, you can take the QBI deduction as long as you meet the criteria.
And when do you, this might be a bigger question, I don't know, but when do you recommend that small business owners incorporate in some way, shape, or form? Because Steve and I are not. So when would you recommend that people do?
Really, what I look at is liability wise. Is there any type of liability out there for the type of business you're doing that you would want to have that corporate veil? Because basically what a corporation is, or even an LLC, which is taxed as a corporation or an S Corp, it's a corporate, it's a veil. It protects your personal assets from your business assets and liabilities. So if someone were to come sue you, then you could say, then you would go, okay, do I have a chance of being sued and not be covered, that they could come after my personal assets? Then we always do recommend setting up immediately a corporation or an LLC and then taxing as an S Corp typically.
Right. All right, I'm going to look one more time to see if there's nothing in the chat on Zoom. I think I got all the questions on Facebook. And I do know Sandy's on this page, on our customer page. So I don't know if you have a question, you might post it there and she can answer you privately, or if that's okay, Sandy. I don't know.
Oh, sure. Yeah, no, I actually tune in on some of the Mondays that I'm available. I actually tune in to listen to whoever's talking.